Good morning, everybody, and welcome to our Thursday morning training for GoPro Trading Academy members. So we've been doing quite an extensive series over the last couple of months on our methodology for technical analysis using advanced price action. And we're coming to a point now where we can really start wrapping it up. And although last week we did to an extent do that in our discussion of historical Dodson channels, I did mention that that is one of a few methods that can be used when looking to determine the boundaries of a range. That, of course, being essential for us to be able to determine that that transition period between ranging markets and trending markets. So HCC channels, obviously a key a method, certainly something that I use a lot. But whatever it is that you do use, you need to be in a position to apply whatever method it is absolutely, completely, consistently. You need to be rigorous in your consistency with every aspect of your approach to the market. So what we're going to talk about today is a couple of other methods that you can use. You can use them separately. You can also use them in conjunction with each other. And I'll wrap up today's session with a brief overview on that. And I hope today's session will also be useful for you guys in, especially those of you who are new to the 3 steps to heaven, just to see how those steps are applied practically. Okay, so let's start with a blank chart here on Euro GBP. The time frame really is irrelevant. What I'm going to do is just show you how you can draw in, first of all, your LPO channel. There is already trading on this, by the way, inside the Academy. So this is going to be a bit of a recap. Please feel free to ask me any questions that you might have about this method. Now, LPO basically stands for last phase one. And the reason it's called that is because when we have a trending market and we can identify that that trend has come to an end, we then look to identify the last visible phase one at that point in time that the trend came to an end. So looking at this market, again, I'm just going to pick an obvious point to start, which is all the way back up here, and use our methodology of the, and you can see this is quite an extended bearish wave. It doesn't really matter. Let me just change this to a solid line as well so that you guys can see it properly. So just double checking that isolated low non-relevant over here because it was not followed by an isolated high. And another isolated low that is non-relevant because it was not followed by an isolated high. Another non-relevant isolated low because it wasn't followed by an isolated high, and the market went further on each of these occasions, including down here. So that's quite a long, extended bearish wave. And clearly it is a bearish phase one wave because it broke and closed below the low of the preceding wave, which was here. So that actually took place on this day right here. All right, so that's a bearish phase one. Then we had a phase two. Then we had another bearish phase one here with this lower low, lower close, followed then immediately by a bullish wave, which even at the end of this candle had made a higher high, higher close. So first of the 3 steps to heaven is defining the beginning and ending of each of these waves. The second of the steps is to identify whether they are phase one or phase two waves. So 1, 2, 1, and then a bullish phase one with this higher high, higher close. That clearly represents a breakdown in sequentiality of cyclicity. Now, which means, of course, that our trend is over and we have at least a potential range. Now, at that point in time, we need to ask ourselves, where is the last phase one that we can see? Well, in this case, this is the slightly more challenging part of it, where we have a 1 followed by a 1. The last phase one that you can see at that point in time is, in fact, this bullish wave right here. A lot of people would say, well, no, that's the last phase one. Well, that was the last, beg your pardon, this is the last phase one. This was the last phase one of the trend, but that's not what LPO stands for. It's the last phase one that is visible at that point in time. And that's where this vertical line is. All right, so as it happens, This wave did in fact come to an end on the following day with that high isolated and ringed, as you can see by the following day's candle right here, which meant that the full extent of this wave was in fact there. And we then draw in our horizontal range to take into account the full extent of that wave's dimension. And that is an LPO range in the case where we have a breakdown in sequentiality of cyclicity with a phase one followed by a phase one. Of course, there is the alternative possibility where you have a phase two followed by a phase two, in which case it is in fact the easier situation where it's the last phase one of the trend. So had we had a simpler situation here with a phase two followed by a phase two, then clearly the last phase one would have been this one here. Not only is it the last phase one of the trend, but had the waves looked like my little drawing here, then there would have been a phase two and a phase two. The last phase one at that point in time, where it's visible that the sequentiality of cyclicity has broken down. We probably just need to have that in there as well. The last phase one would have been this wave right here. And it really is as simple as that. Okay, so that's the example of the LPO channel in that scenario. Let's have a look at this one as well. Again, I'm not really concerned about what the time frame is. It's just the look of the chart. All right, so here we had a breakout with this bullish wave, so a potential trend. Here was the phase two, followed by another phase one wave. So that's when it transitioned from being a potential trend to an established trend, with a second phase one outside of the range's price territory, and another phase two wave here. Now remember, this is a phase one because it broke and closed above the previous wave's high. This is a phase two. That's a phase one, again with a higher close on 2 days. The question then is, what kind of wave do we have here? Well, clearly this, with that high being isolated and in fact ringed at the end of that day, we have a phase two followed by a phase two. Therefore, at this point in time, where in fact what I need to do is point out it would be on at the end of this day, with this low isolated and ringed, we had phase two. Beg your pardon, I'm jumping ahead of myself. At the end of this day, where that high was ringed and we had a phase two, then the last phase one that is visible at this point in time, at the end of the trend where we've had the breakdown in sequentiality of cyclicity, which is when that high was ringed, was this phase one's price territory. And you would then draw in the LPO channel based on that. Now, you'll notice that the following wave tested that resistance level, but it was a failed test because although the price went outside of it, it failed to close outside of it. So a completely failed test. However, it does, if you're going to take the conservative route here, then you need to expand the price territory to take that into account. So I see some questions about ATR. It's completely irrelevant to our discussion. Yes, I'm going to delete that. All right. So LPO over here, last phase one. This is a case where we have phase two. That's the last visible phase one wave. We had a failed test outside of that channel. Therefore, we can redefine the channel boundaries. Certainly, that would be the more conservative route to take. There is an alternative, less conservative approach where if we fail to have an outside close, then we do not take into account the, in this case, the wick, or if it's a bearish test, the tail. What's interesting here, of course, is that when we finally did get a breakout, was in the bearish direction, and therefore on the 3 Rs, we got a reversal. You can see how the price came back to test that exact was support resistance level and failed there beautifully. So not a bad indication, therefore, of support and resistance. All right, so 2 examples there of the LPO channel, one with a phase one breakdown in cyclicity, the other phase two. Remember, all we're looking for is the last phase one that is visible at the moment in time that you can see cyclicity has broken down. All right, so next is for us to discuss again the WM patterns. We call them heuristics. So heuristic is simply a mental shortcut. The WM patterns I've discussed before. There's quite a bit of training in the skill set section. I think I've got at least 2 training videos in there already. So just a quick recap on that. Now, the WM patterns, again, what we do there is we look at the last 4 waves. So I'm going to just use this example over here. The WM patterns as well are basically a simplified version, as you'll recognize, of the HTC channels. Instead of looking back a certain number of candles from our reference wave, all we do is we take the reference wave. So I assume all of you guys have done the training or watched the video training on the HTC channels. We have our last 4 completed waves in place. I'm going to leave the LPO channel in place over here just so you can see in a minute how we combine these. But what we then do is we look to identify, first of all, where the reference wave is. It's the same wave as our HTC 4-wave channel requires. So it's the 3rd last completed wave or the 4th last wave. We don't look back from that. All we do is we identify, in fact, the starting point of that. Now, what makes this a little bit tricky for folks is that when we are looking to see if we have a valid W, or in this case, M pattern, it's normally before the pattern actually forms. So we're looking for the potential for that. So what I'd like you to picture is at the end of this day, where we have this high testing inside of our LPO range, at the end of that day, from a single time frame perspective, we this bullish wave had not yet come to an end. It was still incomplete. And therefore, we're still looking at this effectively as a W, aren't we? So we've got the 4 waves, but as you know by now, what we do is we label the points of the waves. And this comes from trading harmonic patterns and Elliott wave theory, where we've got X, A, B, C, and D is always moving. Now, what we're looking for is the end of the CD wave. We know that this C to D wave is going to come to an end at some point in time. So we are looking always for a potential C close that is outside of our potential XA. So obviously this bullish wave has come to an end. So having said that, however, we would, even at the end of that day, be considering this as the potential end of this wave, and therefore this is a potential C at this point, and C close, therefore, being the highest close in the BC wave, would have been that candle close right there. So that is our potential C close at the end of this day. This is our potential X. Obviously, it would still be A at that point in time, but we see it as a potential X. And the question we then have is our C close outside of our potential C close, I beg your pardon, outside of our potential X to A? And in this case, the answer clearly would have been yes. This close is not inside that wave's price territory, which means that this, at that point in time, was a valid M pattern, certainly a potentially valid M pattern. When this did roll over on with this candle over here and isolate and ring that high, it then confirmed that as C, it confirmed that as C close, it confirmed that as X, and therefore XA, and also confirmed that C close was outside of XA. Now, there's a whole lot of different ways that we use this technique. If we're just looking to apply it for our impulse strategies, so this is actually a weekly time frame, which is the selection time frame for the daily impulse. It would therefore, at the end of this week, if you're trading the WM patterns, it would have been a valid setup in terms of WM patterns for a bearish daily impulse. Of course, you just need to then look for the final selection criteria on that lower time frame, on the daily or execution time frame. So that applies across the board. So that would be a valid M pattern. Uh, in this case, however, we have combined it with the LPO channel, haven't we? So the LPO channel being still in place over here, we would be looking only to take trades if our final close, the last close of the last candle, is outside of our LPO channel. And of course it is. So if you're combining WM patterns with the LPO channel, then this would in fact be a valid setup for you if you were combining both of them as well. It would be a valid setup for either of them individually, but it would also be a valid setup if you were using them in combination. Now, that's the case here, but it certainly is not always the case. It is absolutely possible to get a valid M or valid W pattern inside of your LPO channel. Um, uh, if this had been, for instance, a very long extended phase one wave and it was the last phase one, then our LPO channel could have been like that, which means that this would have been inside of it. It wasn't in this case, but certainly you will get situations where that is the case. The final and I guess the most complex combination of all of our methods is to combine LPO, WM patterns together with the third method, which of course is our HDC channels. Now, there's nothing wrong with doing that either. It is quite a good mix because by combining LPO and HDC channels together alone and ignoring WM patterns, you're being a little bit more aggressive because you're looking for the breakout of either of them. It doesn't have to be a breakout of both the LPO and HDC channels. You're looking for a breakout of either of them. Whichever comes first, you go with that. And in fact, that's the whole point of combining HDC channels with LPO, is because they both have their drawbacks in terms of being the HDC tends to lag a little bit on one side, and that's the drawback of HDC channels, whereas the drawback of LPO channels is that they don't give as much emphasis, or they don't give enough emphasis to more recent price data. They can never get narrower. In other words, they can only get wider, and very often that overemphasizes older price data and ignores the more recent price data. So by combining LPO and HDC channels, we do away with both weaknesses, the weakness of both the HDC and the weakness of the LPO channel. So it is a bit more aggressive though, of course, because if you're using one or the other, you will clearly get fewer trading opportunities compared to if you're combining them. When you add the third layer, which is the WM patterns, instead of being more aggressive, you now bring it back to being a bit more conservative again, because you're adding this extra criteria where you need to have an outside C close on a valid M or W pattern, as well as having a breakout from either HDC or LPO. Which really is the final evolution. There is one extra little complication that you can apply to WM patterns, whereby you can require point your X to be a 5-candle fractal, and you'll recall from our HDC channel discussion why that would make sense. So in actual fact, this is a 3-candle fractal because we don't have 2 higher lows on the right, even though we do on the left. It's a 3-candle fractal. Therefore, if you wanted to apply that rule, you would need to move this further down here. That can get quite interesting, especially if this had been a bearish trend before this. But for our purposes right now, I think it's that probably makes a lot of sense to you. If that was the case here, it actually wouldn't change anything because this is still an outside C close. But I'm sure you could picture the possibility of the 5-candle fractal being lowered down, in which case we would have then had an inside C close, which would have invalidated this as an M pattern. And that's it, folks. That's pretty much it. There's once you start getting into the swing of things with these different methodologies, and you can see how they all actually fit together neatly like the pieces of a puzzle, and you practice doing it, it gets really straightforward to be able to trade using these techniques. Right, so open to questions from you guys.